We're tackling the calculation questions you'll face on the property and casualty exam. These questions are less about complex math and more about setting up the problem correctly. Let's start with actual cash value, or ACV. The formula is simply replacement cost minus depreciation. The exam will give you the replacement cost, the item's age, and its useful life. For example, a 10-year-old roof with a 20-year useful life and a replacement cost of $20,000 has depreciated by 50%, or $10,000. So its ACV is $10,000. A common trap is confusing ACV with replacement cost coverage, which pays to replace the item with new property of like kind and quality, without subtracting depreciation. Next up is the deductible, which is always the insured's share of the loss. It is subtracted from the total amount of the loss, not from the policy limit. If you have a $50,000 fire loss and a $1,000 deductible, the insurer pays $49,000. The exam will try to trick you by presenting a loss that is well below the policy limit, making you think the deductible doesn't apply, but it always comes off the loss first. Now for liability limits. With split limits, such as 100, 300, 100, you have separate limits for bodily injury per person, bodily injury per accident, and property damage per accident. A combined single limit, say $500,000, provides one large pool of money that can be used for both bodily injury and property damage in any combination until the limit is exhausted. The exam trap here is misapplying the per-person limit in a split-limit scenario when multiple people are injured. Coinsurance penalties are a major exam topic. The formula to remember is the amount of insurance you did carry divided by the amount you should carry multiplied by the amount of the loss. The should carry amount is typically 80% of the property's replacement cost. If a building is worth $1 million and has an 80% coinsurance clause, the owner should carry at least $800,000 in coverage. If they only carry $600,000, they are underinsured. For a $200,000 partial loss, the formula would be $600,000 divided by $800,000, which is 75%. The policy would pay 75% of the loss, or $150,000, less the deductible. The period of restoration in business income coverage begins after a direct physical loss and ends when the property is, or reasonably should be, repaired and operations are resumed. Most policies include a time-based deductible, often 72 hours, meaning the period of restoration doesn't start until 3 days after the loss. Finally, premium audit adjustments. For policies like workers' compensation, the initial premium is an estimate based on projected payroll. At the end of the policy term, an audit determines the actual payroll. If actual payroll was higher than estimated, the insured will owe an additional premium. If it was lower, they will receive a return premium. A great mental shortcut for all these problems is set it up before you sum it up. Always identify the calculation type, write down the formula, and plug in the numbers from the question before you ever start the math. This simple step prevents most errors under exam pressure. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.